What the fuck was that?
Did you hear that?
No.
Is that your stomach?
That should be some great audio.
Holy
smoke! Yeah.
Shit.
Yeah. Well, let me tell you something. I did a 3-day fast, and my stomach never did that.
No.
So I don't know what's going on in there right now. Holy shit! That's crazy.
I don't know. I don't know what I could say. I don't know. We don't have enough experience yet with it, but we can say
we can kind of speak on to it a little bit. I think the biggest changes that are happening in our markets right now is there's a lot of consolidation, right? Banks are not able to draw the same revenue that they have in the past, and are looking to do mergers and acquisitions, and sometimes people are looking to make changes in the industry. Not always are those changes, sought out by you. Sometimes they are dictated to you. And in the case like us, we ended up getting acquired by CMG, and it turned out to be what I think is going to be a great relationship moving forward. But the landscape of our market right now is very, very volatile.
I mean, the market's forced it, right? And I think this does happen from time to time. It's very cyclical. This happened to be a particularly extreme cycle, but I think the consolidation leads to more strength for both companies, right? So, combining forces in a time where margins are restricted, I think, is a smart thing to do. Again, we've seen it before, but not quite this extreme. But I think there'll be more consolidation, and I think what you're going to have is fewer, stronger companies.
Right. The one nice thing that I took from this acquisition is their servicing portfolio.
Yeah.
Moving forward, a lot of banks rely on the revenue from loan origination, and here at CMG we have the ability to generate a lot of revenue from the servicing portfolio, which now gives us a leg up because now we're able to be even more competitive than we were before. Right.
Well, it's another line of revenue that I think is very important in a time like this. So it's the mortgage business in itself is a cyclical business, and what you learn, the stronger companies learn that in good times you sort of invest and you save for times like this, but having additional lines of revenue I think is very important. So having a large servicing portfolio does help companies to sort of weather the storm and still provide the same level of service, great rates. Right, you don't have to compromise on those things if you have this other revenue stream. So yeah, I think that's a great benefit.
So when we talk about servicing piece of it, what does that really mean?
Yeah, so I mean it's simply setting up a mechanism where you're collecting the monthly payments from the customer, collecting the monthly payments, sending it out to the investor. You're taking a piece of revenue for providing that service.
But not every company does it.
Not every company does it, no.
And I also think the benefit too for us as loan officers, originators, is that your client stays with you from the beginning all the way through the end, because naturally a lot of loans that are originated, those are sold off to other investors and other servicers, and you lose that connection with your client. Yeah. So there's also that benefit of it as well.
And when the time comes for that client to refinance down the road, just having the ability to net escrows, right? Which is basically when you're refinancing, if you're going to another company, an entirely new escrow account needs to be established and reconciled at that closing. Typically, people, when they refinance, will take that new escrow creation, they'll put it into their new mortgage and increase their mortgage balance further. But when you're servicing the loan and you refinance, you get to net the escrows, which basically means you're taking the escrow that the company currently has in their servicing portfolio and you're applying it to the creation of their new escrow account. So when you refinance, you actually are reconciling less in terms of escrow and lowering your loan amount. So I think there are a number of benefits.
And your monthly payment as a result. And speaking of that aspect of it, we actually have a great program called Rate Rebound. So staying on that topic, a great program that is unique to CMG is what we call Rate Rebound. And this is something that I believe is even really more important today than other times, simply because when you choose a lender, to know that you have the benefit of reduced fees when you refinance in 12 months, 18 months, 2 years, whatever it is, because it is going to happen.
Yeah.
And to have an opportunity where, as you pointed out about negating your escrows, and then on top of that, maybe saving upwards of $3,000 and not having to pay bank fees, appraisal fees.
Right.
I mean, these are huge benefits, and another reason why we're happy to be at CMG.
Yeah. I think that the rate rebound is going to be extremely important for anybody purchasing, within the next 12 months. I think if you polled economists, I think you would get them split down the middle in terms of if we're going into a recession or not. But I think every economist that you speak to would all be in agreement that we are headed in that direction. Right, and I think that is one of the reasons that everyone is predicting a significant decline in interest rates over the next 12 to 24 months.
Can't happen soon enough, my friend.
But the rate rebound is great because we're going to contribute. I think it's close to $3,500 in closing cost benefit to anybody that purchases today and within the next year, within the next 12 months. That winds up refinancing. I think we pushed it out to sometime in 2025. Right. Which means that if you purchase now, lock in your interest rate, you close. If rates go down between now and 2025, you're actually going to be able to benefit from this rate rebound. We're going to contribute close to $3,500 in closing cost benefit by coming back to us for your refinance.
Right, and watching out your escrows. And then the last piece is doing what we call a CEMA, Consolidation Extension Modification Agreement, which is a great way to reduce your closing costs by saving money on your mortgage recording tax. So typically we pay mortgage recording tax at the time of purchase, which equates to about 0.8% of what you borrow. So rather than paying mortgage tax again a second time, especially if you're going to an outside lender, by staying in-house, we could absorb that fee and only pay tax on the difference between your old loan and your new loan, which is next to nothing.
Yeah, absolutely right.
So Rate Rebounder, CMG, good stuff. All right, so that was good. So Chris, do you have a story you want to share with me?
Yeah, I have a story. So this one time.
In band camp?
Shit. I have a first-time home buyer. Like many of my buyers right now, they're feeling a certain way about the market. And why are they feeling a certain way? Mostly because of what they are seeing and hearing in the media about home prices, about interest rates. So are prices high right now? Yes, they are. Are rates higher than normal? Or higher than what we're used to over the past several years? Yes, they are. However, I was able to explain the situation to one of my first-time home buyers to make them comfortable with the price and see that it is still a good investment. They were paying $3,000 a month in rent, right? So paying $3,000 a month in rent versus what they could be paying to own a home, even at these elevated price points. So without getting into the details, I was able to show them that the $3,000 a month in rent over a 5-year period is going to cost them over $150,000 in rent, right? You get nothing for that. You're taking a match to the money. Whereas if they purchased a home and maybe they feel the price is high, the rate's high, their payment's $4,000 a month, right? So they're spending another $1,000 a month. Sure. So it's another, $36,000 over the next 3 years to own. However, what they're not realizing is the equity that they're building, the net worth that they're building. So, with modest appreciation over a 5-year period, purchasing a $700,000 home,
you're going to gain about $150,000 in equity in that property with just a modest 3% rate of appreciation, right? So if you look at the net swing, $150,000 in rent out the window, $150,000 worth of equity built, right, coupled with paying down the mortgage, it's a $300,000 swing in net worth over a 5-year period. When you show people things like that, it makes the higher payment more palatable. And, right, knowing that you will be able to refinance within the next 24 months, I think makes it even more attractive to purchase.
You know, it's funny. So naturally, somebody going from a rental to ownership, home ownership, is going to have a higher monthly payment. It's just the way it is. But to your point, in the example you gave, if somebody is increasing their payment by $1,000, one of the things that I share with my clients is, hey, speak to your accountant and maybe adjust your dependents and free up some more money on a monthly basis out of your paycheck,
right,
rather than getting that tax deduction at the end of the year that you're going to get now because you are a homeowner, you have tax write-off, you have
right,
interest write-offs. So maybe that $1,000 difference is really only a few $100s,
right,
and not so scary at all.
Let's not forget to factor in the interest deduction, right?
Right.
So I tell people all the time, when you're making your mortgage payment, every bit of your mortgage payment is composed of an interest component and a principal component. Every bit of principal that you pay, you're just paying yourself back. It's like contributing to your own 401k.
Right.
And every bit of interest that you pay, you know, if you qualify, is tax deductible. So it's a no-brainer, you know, for people to purchase now. And another thing that I would share is, you think values are elevated today. We do not expect values to go down at all. Values are elevated today because of a lack of inventory, right?
Yep.
As interest rates go down, so it's typically hand in hand. As rates go down, values go up, right? Values are elevated because of a lack of inventory over the next 12 to 24 months. As rates begin to go down, we expect more inventory to come to market, right? But the lower rates are supportive of higher home prices, right? So for that reason, we do not expect prices to come down, but rates will come down. But when rates come down, you're going to have much more competition.
100%.
So what is that competition going to lead to? Higher prices.
Right.
So I try to explain to everyone looking to purchase who doesn't think it's a good time to purchase, I tell them now is a great time to purchase. You have a window right now where you're actually getting in at a discount. Refinance the loan later, right?
Chris, what's my phrase, man? What do I always say?
I know your phrase.
What is it?
It's not timing the market, it's time in the market. And it's true. That's true.
So here at CMG, we have a signature product called Home Funded, and Home Funded is a online crowd funded. That didn't flow out well.
Oh, that sucked.
That's
Kidding. I'm joking.
You start it.
No, I actually don't know it as well as you. You talk about it. I'll be the second golf commentator.
All right.
Just not.
So one of the signature products that CMG has is called Home Funded. What would you call it? I think I have.
It's almost like a GoFundMe for
a down payment. That's what it is. I got it. All right. So one of the benefits, one of the signature programs at CMG is called Home Funded. And Home Funded is a down payment gifting program that is done online. We're all familiar with GoFundMe.
Yeah.
Well, this is a very similar type of program that allows people to donate, contribute to either friends, family, colleagues. It could be anywhere. One of I would say the biggest struggles for any first-time home buyer is what?
It's down payment.
Down payment. So here is a solution for people that are finding it difficult to do it on their own. And we don't have to do it through the traditional ways where we're just asking mom and dad or, maybe a sibling. We can
Right.
go outside of that. And I think that's where the draw is for me. And what I really love about it is, life has a funny way of rearing its ugly head, and sometimes our life goes sideways, and whether it's a divorce, whether it's an ailment, but to reach out to your circle of your sphere and ask for help, what a great way and tool to utilize to help raise money for the purpose of purchasing a house. Because, listen, not everybody's path is the same.
Well, we see it every day with GoFundMe, right? I mean, it would be a perfect example for non-real estate type of, support system. People do GoFundMe every day for various issues, right? It could just be help, like you said, with an ailment. It could be help to purchase something. This is very similar, right? It gives people the ability to sort of pay it forward. I think down payment closing costs are an impediment to, particularly for first-time home buyers. And when they get gifts, we've seen it being in this industry for over 20 years. We've seen it many times where people would get gifts from non-relatives. Becomes an issue. This program solves that issue,
right?
Among other things,
right. So they say it's a frictionless process, right? Because there is a little bit of friction when you're applying for a loan and you have to source, source gifts from donors, with having to do gift letters and having to do copies of checks and sometimes even having to look at your donors' bank statements. Yeah. So this is a great way to avoid having to do any of that stuff. And I believe you can actually gift up to $5,000 per donor.
Per donor, yeah.
So it can definitely cover, a lot of your needs for closing costs and down payment. The other piece to home fund it is called Up It. And Up It is a personalized website that you can share with people to actually make online purchases. And those online purchases, a percentage of that goes to your funded page. Yeah. So it's another way. So, asking people for donations, again, some people are going to have resistance to that, but maybe this is a softer approach to somebody saying, all right, if you're not comfortable donating $50, $100, maybe you can just consider doing some online purchases that you would do normally on your own, but do it through my website, so a percentage of those purchases can come back to me and help aid me in the my quest for purchasing a home. So I think that is another.
It's huge.
It's another huge benefit to this program. And again, we're doing this with the mindset of helping people get into a home.
And the Up It, it's very much like credit card rewards, right?
Yeah.
Purchasing, you're getting cash back. It's a very similar process. So I think they give buyers a number of ways to try and accumulate those funds for down payment and closing costs. Another thing I would mention is it allows $5,000 contribution per contributor, but that would not prevent a parent, let's say, from giving a higher amount separately, just not through. So you can combine, a gift from a parent,
a traditional gift.
Right? Exactly. So, yeah, it's a great alternative for people, particularly in this market.
So, we're hearing a lot today. We're hearing a lot today about LLPAs, which are loan level price adjustments, and how, we're getting some folks are getting penalized because of their good credit and rewarded if you don't have their, the good credit. But I think one of the takeaways that's being lost here is that, the credit profile has completely changed.
Absolutely.
Right?
Absolutely.
So for 20 plus years that Chris and I have both been in the industry, 740 was always considered the top tier, credit score, and that has ballooned to now 780. Yeah. And the 740 score is more like somebody with a 700 credit score.
Relatively speaking. Yeah.
Right. So what is that, in your opinion, what does that do for, I hate to be negative, but it is the reality of where we are today.
I think it moves the goalposts further out, right? I think they've changed the pricing adjustments, and this is coming from Fannie Mae and Freddie Mac. It's not the actual lenders that have put this in place, but I think it moves the goalposts in a number of ways. One, it extends out that top tier. It used to be 740 and above was the same. You were considered top tier credit by Fannie Mae and Freddie Mac. Today, that number is now ballooned to 780. So that's a bit of a difference. So it's costing you a bit more, right? Lower credit score borrowers are getting a benefit, which is a positive. for them. But I you know,
But would you say it's taking away from, the people with the better credit? Because that seems to be the connotation, right? That
It's-
the people with the higher credit scores are the ones that are paying for the ones with the lower scores.
The move seems a bit punitive to the market in general at a time when the market's a bit fragile. So I think the timing of it is probably not ideal. What I think about the actual changes themselves, I think there's some good and there's some bad there. But I think the timing is particularly suspect, and I think that's one of the biggest problems people are having.
And why so
with
much
the changes,
and why so much attention has been drawn to it.
Yeah.
Correct.
Yeah.
But yeah, I agree with you, and I think that the 780 credit score should be rewarded accordingly, opposed to somebody with a 740 score. But it was never the case, prior. So I'm all right with that. And the funny thing is, PMI has always had it right that way, because PMI, if your scores were over 780, you were rewarded for that.
Absolutely, that's a great point.
Right. So now credit is finally catching up to that piece.
That's a great point.
So at the end of the day, it's even more important, that credit is something that needs to be focused on, especially if you're in the pursuit of buying a house. There are certain things that consumers can do to help improve their scores. We're lucky that we have simulators that allow us to run models to try to improve somebody's score, and we do this for the purpose of helping them have a better interest rates and lower monthly payments, and we can't say that for every lender out there.
Right. No, I think it's absolutely right. So let's talk about rates.
No.
Yeah, I mean, I would say the two most talked about topics in real estate today are interest rate and inventory. Let's talk about rate for a minute, just to get some perspective, right?
Okay. Yeah.
I think that everyone has been so conditioned to ultra low rates, right? Which was not normal.
No.
Right? But when you're conditioned to that for a decade, that's what you know and that's what you expect. Right? So the move up right now seems so shocking because people became accustomed to rates in the 3s and 4s. If you look at this chart, Meg,
Perfect.
right? What you'll see is this is a chart from the Federal Reserve showing interest rates over the past 50 years, right? So this goes back to 1970. And what you'll see is a red horizontal trend line. That line is basically the average over the past 50 years. That average rate is just over 6.25, right?
Which is where we are today.
Which is roughly where we are today. Okay,
Shockingly.
that has been the average over the past 50 years. And if you really look at the chart, there's only a few times over the past 50 years that rates have been under that 6.25 trend line. Those few times are the Great Recession, right? So between the 2005, when you started to see cracks in that foundation of the mortgage market,
Which this chart actually does reflect. If you look at the vertical lines, the shaded lines, that is indicating when the actual recessions took place.
Exactly. That's exactly right. So you would see, though, so that's I'm going to bring up another point about that, but what you'll see is there's only been a few times in the past 50 years that rates have actually been below where we are today. Now, it was the Great Recession, right? And then it was 3 or 4 rounds of quantitative easing to get us through that period of time.
And quantitative easing is what?
It's basically the Fed pumping money into the financial system, right? They were being very supportive of keeping rates artificially low. It was not based on a normally functioning market and market fundamentals. So rates are kept artificially low for an extended period of time, and then of course COVID hit, and we know what happened there. But if you look at this trend line, there's only been a few times in over the past 50 years that rates have actually been lower than they are today. Bring up your point about the shaded areas. Those shaded areas are indicative of recession. So those are the recessions. So we've had 7 over the past 50 years, right? And what you'll see is the same trend playing out. Every single time this country has gone into recession, you see the same thing. As per the chart, you're going to see rates go up, 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 right? It's part of the Fed's it's Fed's tightening campaign. You see, country goes into recession, and what happens immediately following, rates come down, and that's because the Fed has to cut interest rates. That's one of their, one of the
driving forces,
most significant tools that they have in their arsenal to inspire growth, right, in the country, is their ability to control, Fed funds rate and their interest rate policy. So every single time we come to that gray line, right, it's a recession, what happens? Rates march on up, get to the recession, rates come straight down. That's exactly what we're experiencing today as we go toward a recession. So I think economists will maybe debate whether or not we will actually get there, but no one debates that we're going in that direction.
So it's not if, it's a matter of when.
It's just a matter of when. In fact, if you will look at
this slide,
basically what it shows is predictions for interest rate trajectory for the remainder of the year. So you have CNBC's predicting that mortgage rates on 30-year fixed program will fall to actually 4.5% by the end of 2023. I think that's a bit aggressive. As per Market Insider, rates are going to fall to 5.4% by the end of the year and going into 2024. So even if you take that less conservative or that more conservative estimate, it's still close to a point lower than we are today. So if you split the difference, we're coming close to 5%. So that's where we're headed.
So question for you. So, we were talking about, in another segment about our rate rebounder program,
Mm-hmm.
right? So at what point does it make sense, in your opinion, to refinance? So if you did secure a rate today of, say, 6.5,
yeah.
When does it make sense to refinance?
I think it's you can easily do that calculation by determining, okay, what's the cost to refinance and what's the monthly benefit, right? So you just determine that break-even period. Typically, if you're repaying yourself within 24 to 36 months in terms of the costs that you save covering the costs that you spent to refinance, then it makes sense. I think what's going to be interesting is to see when you actually pick that point to lock, right. Because we are going to be on a trend of declining interest rates, right. For some time. So it's really trying to time the market as best as possible.
But we can't time the market, Chris.
It's time in the market.
Yes, sir. So what would you say as like a general rule of thumb? I think a lot of it has to do with loan size, of course. I mean, you have to break the numbers down and establish your break-even point. But would you say like a general rule of thumb would be 0.75%, maybe 1% reduction in interest rate? Would that be enough for somebody to pull the trigger?
Again, it's a lot of it's based on loan size, right? Because 1% on $1 million loan is a much more significant difference than 1% on a $300,000 loan. But a 1% reduction in interest rate is significant. It's a material difference.
Because I think the old rule of thumb was 2.
Yeah,
that's that right. Like the old. So you say 2%. You have to cut your rate by 2%, which is not really the case.
I think that's basically from when they first started charting these interest rates in 1970. 2% was probably based on what homes were valued at that period of time and the average loan size at that period of time. I think a 1% reduction in rate for at least in our market is going to be certainly enough to consider refinancing. And we will see that reduction. It's a matter of time. Within the next 12 to 24 months, it's almost a certainty that we're going to see that type of reduction in rate.
Right. And what would you say to the people that say, all right, well, that's all fine and good for the refinance people, but the ones that are not willing to step into the market today and want to wait until those rates are in the 5s?
I think that's a mistake. And the reason it's a mistake, right? Again, going back to your theme, John, of not trying to time the market, the reason that's a mistake is because that same home that you're looking at today will be at least as expensive in terms of price this time next year, but likely it'll be more expensive. Right. And even with increased competition, with more homes coming to market, the reduction in interest rate is going to be supportive of that higher value, right? So we don't expect values to come down really at all over the foreseeable future. So we're not. So the point would be, if you like the house, if you love it,
and you can
afford it,
right?
Buy it now before you have even more people competing for that property. Buy it now, refinance later.
Love it. One of my buddies is in the process of trying to sell and buy.
Yeah.
And Axos.
I remember Axos, yeah.
Axos allowed him to exclude his current mortgage on his primary.
How?
Because his house was listed and not in contract.
That's
Again, it's not for everybody.
Yes.
And you're going to obviously have a premium associated to it.
Right.
But
It's
it's a mechanism to get the transaction done.
Yeah.
No, that's true. I mean that's a very I know it's an obscure program, but it's nice to have that.
It's kind of like one of those cross collateralization programs too. Those are out there.
Yeah. And you run into it more often than you think, right? I mean, I run into that all the time, and it's a very difficult thing for somebody purchasing a home. You would think that there'd be a better process for it, but most people buying a home have to sell their existing home.
Correct.
Most people do, right? But the challenge right now is getting an offer accepted on a new purchase. No one will allow it to be contingent on their sale. Right. So you're almost rolling the dice every time that you sign that, unless you've sold already. So it's that timing issue, and most people don't want to, commit to selling before they found something. Right? And particularly in this market, you could find 50 somethings and not win that bid. But now you're locked into your sale. So what do? You have to find this, you have to have this contingency plan. Maybe you're going to rent. You have to find a short-term rental, right? And then you have to move twice. And it's a problem. It's a problem. So having programs like that, I think, are really attractive for people to know that option is out there. Maybe it's not going to be plan A for them, right? It's not ideal, but you have a plan B, which, if you find a house that you love, should inspire you to go out and make that offer. You can do it with confidence, knowing that these programs exist.
Yeah, I was gonna, another piece of that where I think people don't really think about is wanting to sell and purchase, but not having the necessary capital to enter into contract.
Yeah, that's another problem. Yep.
Right. So it's happened more than I can even count, where somebody says to me, "Yeah, I want to sell and buy," and then we go through all the scenarios, and then I say, "All right, well, how much do you have for disposable cash?" Well, everything's tied up in my house.
Yeah.
And at this point, they even have their house listed already.
Yeah.
Well, that doesn't help.
No.
So I think for those folks who are equity rich and cash poor, maybe establishing a line of credit prior to putting your house on the market, so you can draw on the equity of your home for the source of down payment, and then hopefully once you identify a home and you sell yours, you just pay off both liens and everything is good.
That is a great solution as well. You need to do that prior to listing your house.
Prior to listing is the key, yes.
Yeah.
And again, you can also use gifts as a source of down payment too. So if you have a family member that has deep pockets, you could always draw on them, and then obviously, I shouldn't say this, but reimburse them afterwards, because it's not a loan, it's a gift. Sorry. But that is the truth. So you'd get a temporary gift from a family member, what have you, and you could always work it out down the road.
Yeah, there are ways to do this, right? It's just coming up. It's speaking to the right person, right? Advice, I think, is very important. Advice from the right person is invaluable, right? So you have ways to handle situations like that, that you just mentioned. And I run into that quite a bit. That and for most people, right? If you own a home, most of your savings, went into purchasing that home, right? Most people don't own their home and have a significant store of savings, right? So just putting that 10% down on contract can be problematic. The HELOC, I think, is a great solution on the existing home to remedy that issue.
Agreed.
Isn't it?
It is.